Hello, I'm Jamie, financial planner at Magenta. This video is about how to save for retirement when you're self-employed. Now, there are an estimated 5 million self-employed people in the UK, and perhaps you're one of them. The self-employed way of working is, of course, different to employed life in lots of different ways. Typically, self-employment comes with more freedom and choice with no one telling you what to do, which is great, but us humans are notoriously bad about thinking about the future and planning for it. So when it comes to planning for retirement and putting money away, this can be a bit of a blind spot for a lot of self-employed people, as there's no one making them do it. Making sure that your self-employment works for you now is of course the most important thing, but once you're satisfied that's the case, you need to think about what comes after. Of course, I'm talking about retirement. Before deciding how much to save for retirement or how to do it, you should ask yourself whether your business will be worth anything. In some cases, people will have the business itself, business assets or clients or intellectual property or something else which should be factored into their retirement plan. And if this is you, then you shouldn't rely solely on this and instead should think about a diversified approach because, let's face it, who knows if those assets will be worth as much as you hope and be able to sell them when you need to. In other cases, you as the individual are the business and there will be little or nothing to sell on as you enter retirement. And if this sounds like you, then you need to work out how to fund your retirement in more conventional ways, such as with pensions and savings perhaps. So the question, why should you save for retirement? Well, some types of saving for the self-employed can be really tax efficient, such as employer pension contributions. If you operate under a limited company structure, there are two really good reasons to consider pension contributions, aside from the obvious putting away money for the future. First of all, these are allowances for business expenses, meaning they lower your corporation tax if you operate under a limited company. And something that not a lot of people know is that these are not subject to the usual annual allowance limits of 40,000 that individuals are subject to. So as long as you have the cash in the business, you can make employer contributions well above the standard £40,000 annual limit. If you operate under a different structure or make contributions personally, you will get tax relief for your highest personal tax rate, and it will bring down the levy of your income subject to income tax for the year. That's pensions, but of course there are other good ways to save for retirement too. One of these is lifetime ISAs, and you may have heard of them for saving for a house. They've replaced Help to Buy ISAs for that purpose. And yes, they do that, but they can also be used to save towards retirement. Anyone under 40 can start one, and you can put in up to £4,000 a year and get a 25% bonus of whatever you put in. £4,000 will get you a £1,000 bonus. The downside is you can't access them until age 60, however. Another option is stocks and shares ISAs, and you don't get bonuses on stocks and shares ISAs, but you can put in up to £20,000 each year. Importantly, there's no age restriction on drawing from them, so you could put some money into lifetime ISA to get the bonus and put the remaining allowance of £15,000 into a stocks and shares ISA. If you did this, part of it you could access after 60, most of it you could access flexibly before. Now ideally you'd want to put money into ISAs and pensions on a regular basis. If your cash flow is pretty regular, then this is a really good habit to get into. However, if, like most self-employed people, your cash flow is a bit more lumpy, then try to build up cash during the year and near the end of the financial year, commit to reviewing how much you can put in as a lump sum. There you are then, 3 tax-efficient investment vehicles to consider to work hard for you to build up a good nest egg for retirement. Pension, lifetime ISA, and stocks and shares ISA. Hopefully you found this video about how to save for retirement if you're self-employed useful. If so, it'd be great if you could give it a like, comment or share with your network. And as usual, if you'd like to have a chat about your personal circumstances, please feel free to drop me a message. Thanks for watching and see you soon. Bye bye.